Welcome, everyone. Today I'm joined by Managing Editor James Kleimann to talk about recent lender news, including the very hot M&A market, more drama at loanDepot, and the latest in the rocket UWM battle for brokers. James, welcome back to the podcast.
Hey, good to be back.
Great to have you on. One of the things I love about talking to you is we can do a deep dive on what's happening with different lenders. And right now, one of the things that's happening is we're seeing a lot of M&A activity, which we predicted last year, started last year, but really has been picking up. So what are some of the deals you're looking at?
So we've got a few announcements over the last few days, actually, in the mortgage space. The bigger one is probably Guild Mortgage. You know, they've been very acquisitive. They're, of course, a California-based retail lender, distributed retailer. They're big on the West Coast, but they have been expanding, right? So they picked up Atlanta a few months ago in December. They're based in, I believe, Wisconsin. And really, you know, they're kind of like a true blue, you know, mortgage retail lender, and they have a branch model. And so they are looking to get a little bit bigger, a little bit tougher in the Southwest. And so they very recently picked up a fairly small firm called Legacy Mortgage, and they're picking up 13 branches across Arizona, Colorado, New Mexico, and Texas. And while we don't know the terms of the deal, you know, this is not a very big company that was acquired. They did about $300 million in origination volume in 2022. And, you know, they only have about 40 loan officers. So I imagine the amount of money that was spent by Guild is probably not significant, but you know, every little bit helps when you're looking to compete across the country. And so Guild has been very disciplined in its M&A strategy, and they're not picking up, you know, like big lenders that are their size or, you know, kind of in that ballpark. So for context sake, Guild is probably about the 26th biggest originator in the country. And I would say the company they picked up is probably not even in the top, like 250, 300, right? Like this is a pretty small company. But it's another example of kind of, I think a lot of lenders are really digging in and saying, this is what I'm good at. This is what I'm comfortable with. This is the model that I know I can implement across, you know, different geographic areas. And so this is what we're going to stick with. And Guild is very much probably been one of the most public in you know, letting other lenders in the space know, hey, if you're for sale, if you're having a tough time, if you think we might be good dance partners, like give us a call. And so that's one notable deal. And then, you know, we also published a story this week, just yesterday, on American Pacific Mortgage and Bill Lohman. And we did kind of a deep dive. This is by Connie Kim, mortgage reporter here at HousingWire. And she's looking at, you know, how is APM, which is, again, one of the more acquisitive companies out there, how are they picking up all of these different branches? You know, they're headquartered in California. They've got probably about 3,500 employees, you know, about 1,500 LOs. They're a pretty good sized company, and they've made a lot of deals. In 2022 alone, they picked up Sun Street Lending. They got LendSmart Mortgage out of Minnesota. They picked up 51 branches from AmeriFirst. And of course, they were also in on some of the Finance of America branches once that lender, you know, essentially shut down the forward operations and became a reverse mortgage lender. So, you know, Connie did a great job in talking to Bill Lohman about, you know, how do you examine deals? Like, who do you pursue? What is their profile? You know, how big of the meal are you trying to get when you do decide, you know, to gobble up another company? And, you know, how does it work? Like, you know, how do you find deals? How do you get the leads? You know, do you stick with their branding? Do you integrate them into kind of a, you know, into a larger model? And so it's a really interesting, comprehensive look at, if you are hungry for deals, how do you get it done? You know, like what are the mechanics of M&A in 2023?
I think one of the interesting things about that story for me was the fact that acquired branches can still brand themselves as their existing names if they get bought by American Pacific Mortgage, but they can become then just a division of APM. And while some of the other ones continue to brand themselves under existing names, you know, others have just come right under. And it's a whole strategy, right? From their perspective, like, what do their customers want? Where's the cultural fit? What does that look like?
Sure. And I think you raise a really good point. When we typically see the M&A deals, it's usually a mid-size or larger player saying, okay, you're with me now, and I tell you, how you walk, how you talk, you get integrated into us, not, oh, well, you've done a great job over the last 30 years in your community. You know your customers, you know how the branding works, and you lack maybe like the technological infrastructure, or maybe you lacked, you know, um, you know, something in underwriting, or maybe there was one thing that you didn't have that we can bring to you, and it's almost like a franchise within, like they're not saying we want you to be this, this, and this. They're saying we want you as you are, and we're going to give you the tools to be a better version of you. And I think that is interesting, and it's also somewhat unusual. I can only think of a few deals over the last few years in which, the company that's being acquired is really relatively unchanged. So it's an interesting strategy. I don't know if, let's say if you're a cross country and you pick up, say 10 different small to mid-sized lenders, but they're all known as cross country, Deloitte, or, cross country New Jersey, or, like they lose that identity if that's better overall for your larger strategy of kind of signaling to consumers, this is who we are, this is the experience you get no matter where you are in the country, or if it's better to have more of a kind of a, an individualistic approach. But certainly, something to chew on.
I think American Pacific really embodies like what we were talking about last year. Is like there are people who are seeing this market as an opportunity, and that's kind of one of the things that comes out in that interview. Is Lohman said, the more the disruption, the more the opportunity. When it's too tough for them, it's just right for us. We went into this declining market, prepared to take advantage of it, and you really see that. I mean, this is a strategy that they're able to do, and through this, as you said, I mean, they think they're going to grow originations by 25% just through their M&A.
Yeah, and I think it's also interesting. They're not picking up like the carcasses. They're not picking up someone who's on life support. They are no one's going to suggest that the companies they're picking up are like UWM or Rocket, or or these very big, very profitable enterprises. But they are getting profitable companies. They're not getting companies that are going under and just buying what is effectively intellectual property. They're picking up like viable businesses. And that's not always the case, especially when you get into the smaller origination kind of lenders. If you're a lender who did 100 million in volume last year, like you almost certainly are not making money right now. Now, the higher you get, the more likelihood, the scale does matter in mortgage lending. Like you have to have a certain size and scope to make money in a market like this. And so the lower you go, the less likely it is that those are going to be businesses that would otherwise be able to make it, in a market like this. But if you can find the ones that are overall doing decently and just need a bit of a pick me up, or would benefit from kind of the integration into a larger company that has HR, that has, a lot of processors, that has enough underwriters, that has, a good lead generation build out, you can find quality mortgage loan officers. You can pick up branches in retail locations that are still, viable. I mean, that's the other part of it is in a lot of cases they're picking up actual real estate, and in general right now the trend is, at least in kind of the real estate housing market brokerage mortgage lender business, you want less real estate because it's a fixed cost. And depending on where you are, it can be pretty expensive. Like try to build out a brick and mortar mortgage operation in Beverly Hills, right? Like, you're pretty very quickly going to be in the red. And so they are strategically picking up retail locations, and you have to be really smart about that because, like I said, if you pick wrong, if you end up buying or acquiring the wrong company, you're getting a lot of debt. You're getting a lot of costs that are fixed that you cannot shift. And so you have to be really smart about it. And there are all kinds of little M&A mortgage firms that are specializing in this kind of work. And this is a great opportunity for them. When there is disruption, there's deals to be made. And you either survive and you partner up, or you're big enough, strong enough to make it and just cut half your staff or whatever it is, or you die. And that's, a little bit more of a kind of like an Animal Planet documentary, I guess, but it's true. And that's what we're left with.
It is true. I think the other thing that they're trying, it's a strategy is to spread out to other regions of the country, right? They want to be more diversified than just their. I think they said like 45% of their origination volume in 2022 was concentrated in California. So the goal, they said, is to have that figure go below 40% this year, kind of spread out, which makes all the sense in the world.
And that's true of a lot of the mortgage lenders. I mean, California is like an economy unto itself. I remember a stat when I was in like high school, and it was something like California alone would be like the 5th biggest economy on earth or something. It's such a big market. And for a lot of companies, if you see a dip in California, you take a dip overall because you devoted so much in resources, so much in the infrastructure. Your origination business for a lot of lenders is really built on the strength of California. And California's down, it's a tough market, and not a lot is getting built in California, of course. So I think that's well said. And you see a lot of builders that have mortgage arms that are doing pretty well in areas like, look how Lennar's mortgage company is doing in, the Southeast, right? D.H. Horton, same story. There are other parts of America that are still open for business, and you can make money in the Southeast. You can make money in the Southwest. You can make money in the Midwest. You don't need to rely, and it's probably foolish if you only rely on California.
Absolutely. Well, let's shift a little bit and talk about another one of the big lenders. Let's talk about loanDepot. Lots has happened. So you were, I was out for a bit. You were out for a bit. While we were gone, a lot of things happened when it comes to loanDepot. So get us up to speed on what's going on there.
So I think most people who listen to this podcast probably know of the struggles at loanDepot. They've been, a top 5 lender for, many years. They're a very large, very well-resourced company. They went public, and since the refi boom left us, I guess is the kindest way to say it. They've really struggled to kind of make it in a purchase market, and they've had to do a large number of layoffs. I mean, they've cut, as everybody has, a ton of staff. And we've talked about this also in the past on the podcast, that they've had some, I think, complaints from the workforce about some of the, the corporate perceptions of, how they're resourced, and just some of the craziness of being a worker at loanDepot in some places. I talked to someone a few months ago who's like, I've had 6 managers in the last year, and, every day is a fire drill. Like, you never know what's going on. You never know what's going to happen. And it's a tough place to work right now. It's a tough environment. And so loanDepot, which considers itself to be a very tech forward company, that has been kind of built in sort of the corporate image of its founder, Anthony Shea, has struggled. I think they only did something like $3 billion in origination volume in the fourth quarter. And it's just not enough to sustain. And so they brought in Frank Martel, formerly of CoreLogic. He has a reputation for being a cost cutter in the industry, and he's done exactly that. They've laid off a huge amount of staff. They've done reorganizations. They have really tried to become leaner and meaner, and wanting to fight for kind of a better market, regroup. And most recently, Anthony Shea, he's the largest shareholder at the company by far. I think he has like 42% of economic interests. And then he also has a controlling number of shares on the board. Well, he has been trying to get his own candidate onto the board, and in doing so would be basically bumping an independent director. And so the challenge here has really been Anthony Shea says that he needs someone who's very operations minded and experienced on this board because, they're going through a major operational challenge right now. And his candidate is, very experienced. This is Stephen Ozonian of Wilson Financial Group. He's president. He's been in the game for a very long time. And in nominating Ozonian, he would be bumping Pamela Pattenoud, formerly of HUD, who's been, a very big name in kind of the housing policy space for a long time. And the board basically said, we're still reviewing his candidacy, cool your jets. And Anthony Shea said, no, this is my company. I have all of the economic interests. I have all the, the voting power, and I'm going to push him through. So Anthony Shea is stepping down as executive chairman. There's still a little bit of confusion as to how that manifested. Based on SEC filings, it looks like the board voted 5-2 to remove him from this position. And what happens going forward is really anyone's guess. I don't know if it suggests that things are worse than they seem at loanDepot, but when you have a guy who founded this company, who, would appear to have a number of favorable candidates that are connected to the company and him, in some way, voting against one of his directors and voting for him, or not voting against, but slowing the process, not permitting him to, get him on the board when he wanted him on the board, and then voting to remove him from a position, I think says that there is a corporate crisis at loanDepot right now. And this is one of the 10 biggest mortgage lenders in America. They're absolutely massive. And to see something like this, I think suggests that there's going to be a lot more news in the coming days, and we're going to be tracking the story to see what happens. But it's not great for sure at loanDepot.
That is wild. And, to follow up, Pam Patno, I think her board seat expires, right? As well as Andrew Dodson's in this time period. So it's not even like he's trying to, there's a natural process here. And that's what the story talks about, is that Ozonian was already in there. So why are you making this giant thing about it when they're already considering him, and there's this process going forward? But it sure feels like just more disruption for a lender that really doesn't need any more disruption.
Yeah, absolutely. For sure.
We saw, in the last couple of weeks, we've seen some big teams move from loanDepot over to Revolution Mortgage, just as one example. And you think, there's definitely some poaching going on across the board, not just with them, but people are looking at high performing teams, and in some ways are more valuable than ever if you can grab people, leaders, and teams onto other companies.
Yeah, and this isn't specifically related to loanDepot, but I think generally speaking, sales staff, high-performing sales staff, they want to work at a place that they know is stable, that they know, mommy and daddy are getting along, and and that they can see themselves, doing good business over the next few years. And if someone else comes along with an offer and says, hey, there's a lot of discord there, we don't quite know what's going on, it seems like the board is fighting with the executive chairman and founder, I would bet if your top people at loanDepot are already not getting lots of calls, it's going to start happening now. Sharks smell blood in the water, right?
Absolutely. And that, as we talked about in this particular mortgage environment, there's a lot of that going around.
Yeah, definitely.
So now let's shift to one of the bigger fights. You're talking about, blood in the water that we've been covering for a couple of years, is the ongoing battle between UWM and Rocket. And, the news that we reported on this week about that whole ultimatum and how Rocket is fighting that. So bring me up to speed on that.
Okay. Are you sitting down? Okay.
I am. Yes.
Good. I'm glad you're sitting down. Yeah. This is a saga that is years in the making now, right? I feel like you could drop a time traveler off in a point. They'd be like, what? They did what? And why? And when? And so, yeah, very, very, very brief synopsis. is back in March of 2021, Matt Ishbia goes on Facebook Live, remember when that was a thing, and says, hey, it's a new dawn, it's a new day. We at UWM are here to protect the broker, and Rocket, Pro TPO, and Fairway Independent Mortgage have been working against your interests, and they're trying to get real estate agents to do your job, and this, that, and the other thing. And you shouldn't work with them. They're bad news bears for the mortgage broker channel. And we are, in a kind of like in a paternalistic way, said we're protecting you from yourself by telling you if you do business with them, you can't do business with us. And we are number one in this channel, and those are the rules. And if you violate the rules, we're going to pop you with some pretty big fines. It was like $5,000 a violation or up to $50,000 a month. And so UWM absolutely did follow up on some, follow through on some of those threats. And they took, I want to say like 3 or 4 different mortgage brokerage companies to court, and seeking like millions of dollars in damages based on, the loan volume that they sent and, violations of the broker agreement. And so let's fast forward. Okay, so we're like almost 2 years later, and at a company event with brokers, Mike Fawaz, who's effectively the head of wholesale lending at Rocket Mortgage, gets up on stage and tells brokers, look, the ultimatum is over. It is null and void. We are here to put an end to UWM's bullying ways by basically arming you with money. So if you're a broker and you don't want to deal with this ultimatum, you want to do business with whoever you want, whether it's us, whether it's Fairway, whether it's Carrington, whether it's Home Point, whoever, like, doesn't matter. And UWM goes after you, we're going to pay for it. We're going to pay your legal costs. We're going to pay whatever the violations are that UWM. And so it comes at kind of a funny moment in time. If you ask Rocket and you say like, hey guys, why are you doing this now? Like 2 years later, they'll tell you, well, there's choice in the market now. The pipelines are not full. It's not as hard a choice, I think, is maybe a fair way of looking at it. But I always like to think of these things in very, like, what is the business impetus for doing these things? And regardless of how you feel about the ethics of what UWM did 2 years ago by basically saying you don't have choice, which has always been sort of the broker's, value proposition, right? Like, I can get you 74 different mortgage offers if I wanted, I'll get you the best deal because like I'm personally incentivized to get you the best deal. I don't work for, lender A, lender B, whatever. Regardless of how you feel about that, it was effective. UWM grew with brokers. They attracted, maybe not just specifically they, but brokers or retail LOs came into the channel. UWM capitalized on that. And by engaging in like very aggressive pricing battles and all kinds of initiatives with buy downs and all sorts of new products and promotions, UWM has undoubtedly, probably better than anyone, capitalized on this market. And so, again, regardless of the ethics of it, it worked. The ultimatum did succeed. And Rocket lost brokers. Rocket gained a few that they, previously, were working with that also sent business to UWM. It wasn't like, 100 soldiers come to this side and, none go to that side. It's not like that. But overall, UWM absolutely did attract more brokers to their side of things. And I think this is just my opinion, having spoken to some brokers and talked to a few executives in the space. I think Rocket needs more business out of the wholesale channel, pure and simple. Their business right now, and it has been for a while, is set up predominantly to capitalize on refi markets. There's no refi market in 2023. Like,
no, there isn't.
Maybe you'll get like a little bit here at some point if rates do dip, into the 5s, and you'll see, maybe you can get some people who need to pay off credit card debt or something. There's always going to be a little bit of refi, right? Because there are too many personal financial choices that people can make that might, acquire that product at that time. But as a matter of running a business, you don't want to bank on refi in 2023, right? And so they need they need purchase business. Where does purchase business come? generally speaking, it comes from LOs who know the real estate agent or a financial advisor or like a divorce lawyer in some cases. There are different ways to get it. But that is a generally good source of purchase business. And Rocket is not built for that, right? They have like a call center model, and then they work with brokers, through another channel. But if UWM is saying, I'll effectively make it so difficult, so painful for you to match me on price that you just won't do it because it's not financially in your interest, you need to come up with a new strategy. You need to figure out a way to get those leads, to get that volume coming in. And UWM has overtaken Rocket over the last 2 quarters in volume overall, by not a small amount either. I think it was like 5 or 6 billion in the last quarter. It was even more than that, in the prior quarter. And from what I understand, just looking at data, talking to people in the space, it's going to be the same in the first quarter, and so they need to do something. And so if it costs them 25 million to pay the tab for every possible broker or LO in that space who is annoyed or frustrated with UWM and its policies or whatever, and this is what convinces them to, send them loans, then that's the cost of doing business. What we don't know is what UWM will do, right? They haven't said, they have not communicated, they declined to comment when we asked them, like, hey, what do you think about, Rocket 2 years later deciding to pay these lawsuits, basically. But UWM is a very aggressive player, and I could absolutely see them, taking, another aggressive stance in response. So we'll see. But it's, things are just getting hotter in the broker space.
It is absolutely fascinating to me. And to your point, like 2 years later, and also, what percentage of brokers now are feeling that, or have the people who wanted to switch already switched? And, how many is this, right?
It's hard to say. At the time when we talked about the ultimatum, 2 years ago and almost exactly 2 years ago, actually, Sarah, we were talking about like 3,500 brokers that were kind of like up for grabs, so to speak. And, the majority of them ended up working with UWM. The broker space now is much bigger. We've done a lot of reporting about the migration from retail and, and other sources. So the broker space, I think, is a more open market right now, and so I don't know if, someone who joined from a retailer has an allegiance toward any one lender or not. And maybe they just work with UWM because the pricing, was really good for 6 months. But when the pricing is not as good or when they don't have as much financial incentive, they'll work for whoever gets their borrower the best deal. So it could end up working out. I don't see a lot of downsides unless, they end up just spending a huge amount of money and just not getting much business out of it. If they decided to basically take on, every former broker partner who's run afoul of UWM's broker agreement and they don't actually get any volume out of it, it will be not even a pure victory, right? Like it'll just be embarrassing. But they're a really smart company. There are no dummies at Rocket Mortgage. They have run the biggest mortgage lender for a very long time. When they make a decision like this, they do their homework. They absolutely know what they're getting into. This wasn't done with haste. So maybe they should have done it a little sooner. I think maybe that could have, mitigated some of their losses in the broker space. They could have performed a little bit better if they had done this a year ago, right? But they're doing it now, so we'll see.
Yeah, and I do think that's what's so fascinating about the news, the broker news with Rocket and UWM in there, because these are both really big, smart, ambitious companies who are not afraid to put the money where their mouth is, not afraid on either side to do aggressive things to win over the brokers. So we'll continue to report that out, I know. Thanks for keeping on top of it. Your newsroom's been doing fantastic. And thanks for giving us a roundup of kind of what's going on with lenders.
Thanks so much, Sarah. It's good to be back.